Hi, and welcome to our end of January update from the Wealthy Doctor Institute, Intelligent Investing for the Busy Professional. We focus on simple, battle-tested methods of investing that require less than one adjustment each month to protect and build wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those who are new to the concepts of the book, or for those who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So this month, we're going to cover the topic of the month, then review the 20-month SMA system, then review the MRI system, then remind us about the rules for the 25% stop loss system for individual stocks for those of us who insist on buying individual stocks, and then remind ourselves about sector server systems. So the topic of the month is news and the impact or lack of on the systematic algorithmic investing approach. So what do I mean by that? Here's a graph of the S&P 500 Index Mutual Fund. You've seen this before on previous videos. We can look at the history since 1996. Stocks go up, stocks go down, and clearly there are trends, and clearly there is noise in the markets. It's jagged lines, not smooth lines. And you may be thinking that, well, maybe news does impact the markets. So let's take a closer look at this. So as happened now, back in 2000, there was a controversial election, and here is where it happened. It happened in the middle of a wiggle during the run-up of a bull market that has lasted for decades. Now everyone knows that stock markets crashed because of the dot-com bubble. It wasn't because of some controversial election. But was it really? Now let's take a look. There's another significant historic event here, 9/11. It was so significant that they had to close the stock market for a week. And here it happened, right in the middle of a bear market downturn. In fact, after 9/11, stock markets kept going down for maybe a week before it started going up. Kind of counterintuitive. You would think that bad news would be bad for the markets, but in fact the markets have been going down since 2000. 9/11 just happened to occur in the middle of the bear market. And then, of course, Gulf War II starts here. And yes, you can say that it might be coincidental that it just happened to coincide with a multi-year bull market, or maybe wars are good for stock markets, or that maybe social mood was just so bad that at its nadir there was nowhere else for it to go but up, and it expressed itself in a war to let out steam, so to say. Predicting the effects of news on the markets is extremely difficult and oftentimes counterintuitive if there is any relationship at all. So here's an example. There was another peak here. Now everyone knows that the 2008 crisis was because of the mortgage crisis. But this peak was in October 2007. So what gives? What happened in 2007 to make the markets go down? Well, several things happened in 2007. Petraeus was grilled about the surge, so the surge was already going on. There was a transition in Pakistan. The last Harry Potter novel was published. That's market-moving news, right? The iPhone was actually introduced. The first iPhone was introduced in 2007. So yes, the phone you have in your hand or in your pocket, less than 10 years old, has transformed our lives. Virginia Tech massacre. This was back when massacres weren't so common. Market-moving news, right? Enough to tank the markets or start the tank before the mortgage crisis hit. And there was a massive Chinese toy recall. Well, pick your pick. Maybe markets have something to do with news, or maybe the news impact isn't so much. Now let's look at some more recent news. For instance, Brexit happened right here in the middle of a run-up. In fact, the S&P 500 broke above its previous highs when Brexit happened, and it just kept on going. It was just a small blip in the grand scheme of things, and doesn't even show up on the monthly chart. And now here, you can probably recognize the Trump bump, when markets were going down a little bit for a couple of months, and then it started going up again. And the reason why I bring this up is because this past month I've been asked so many times, gee, what do you think the markets will happen now that Trump's in power? You can speculate all you want. I mean, everyone seems to have an opinion about how Trump will affect the economy. But there is some consensus that, of course, Trump is going to affect the economy. But it seems mixed. For instance, sure, Trump might be good for the economy from tax reforms or regulatory relief or non-traditional infrastructure spending plans, but then again, maybe Trump would destroy the economy because of trade policies or immigration reform or geopolitical risks. I mean, it's a big question mark what's going to happen with Trump. But the good news is, when we use our systems, we let our systems objectively look at the footprints of every trader invested in the markets. Every single person who ever does any trade produces a mark on the markets. Every single dot on the graphs represent when a buyer and seller agree on a price. And when buyers and sellers agree on prices over time, let the markets tell us what to do. Don't try to predict the markets. So our first system that we're going to review is the 20-month simple moving average system, abbreviated to 20-month SMA. The rules are simple. If the price of the S&P 500 index is above the 20-month moving average, it's relatively safe to stay in the index fund. Otherwise, get out. The 20-month moving average is our safety belt, but it only works if we watch it every month. So here's how the 20-month SMA has worked this month. The blue line is the S&P 500 Index Mutual Fund. The smoother red line is the 20-month moving average. And this month, the S&P 500 Index Fund, the ticker symbol for this particular one is VFINX, closed at 210.46, and the moving average is 190.14. So that gives us a nice 10.7% cushion. If we were to enter now, the markets would have to drop more than 10.7% by the end of next month for us to signal a danger zone. So right now, the markets are signaling to us that it's relatively safe to be in stock markets right now. So the observations for this month, the 20-month moving average continues to signal relative safety in the US markets. Now this is despite all this news, especially last week, about Trump bump exhaustion. Markets have been going up for more than a month. You can argue that, okay, December there was the Christmas rally, however the pundits try to interpret the markets. And yes, last week the markets did go down a little bit, but the S&P 500 index is still net positive and still above the 20-month moving average. Now remember, this system is not designed to catch peaks. Even though markets went down a little bit last week, the markets must fall enough for a system to recognize when we're in a danger zone. And just to review Sector Server's analogous strategy called StormGuard Armor. StormGuard Armor has signaled that yes, it's been relatively safe to be in the stock market side rather than the bond market side for the last month. So whether or not you were following a 20-month moving average or the StormGuard Armor, is relatively safe to be in stock market right now. We'll see what happens next month. The next system is the monthly rotation investment system. I abbreviate to the MRI system. So the MRI rules are every month, rank using dividend corrected data the three mutual funds, the S&P 500 Index, the Emerging Markets Index Fund, and the Inverse S&P 500 Index Fund. Every month, rank those three funds, sell the bottom 25% of your entire portfolio, and buy the top fund. This is how we rotate out of weakening trends and into strengthening trends. So how did the MRI do this month? So now you have the data for these three funds from the end of December last month, and from the end of January this month, the S&P 500 index went up 1.9%, the emerging markets went up 4.9%, and the inverse fund went down 1.8%. And here's a graphical representation of what's been going on. So yes, the S&P 500 index has been relatively flat for most of January. It did go up a little bit before it started to drift down and get all their news people something to write about. The inverse fund did the mirror image opposite, and the red line is the emerging markets. So under the current MRI model, we were half in the emerging markets and half in the index fund. Since this month we're supposed to sell the bottom 25%, which is the index fund, and buy the top fund, which is the emerging markets, we now are roughly 75% in the emerging markets and 25% in the index fund. And for those of us who would rather sector surfer rotate the MRI funds instead of using the rotation system that I outlined in my book, this past month, sector surfer has put us in the index fund, even though the emerging markets have been beating the index fund. That's okay. This is how sector surfer works. It's a different algorithm. And the thing to keep in mind with sector surfer is that for this particular strategy, it trades maybe once every other year, and there was no trades triggered for this month. So observations for this month: the emerging markets again showing signs of strength as we once again rotate into emerging markets under the traditional MRI system. However, sector surfer still has not triggered any switch from the S&P 500 fund. Remember, sector surfer uses a different algorithm. Don't mix up the systems. So other systems to monitor, we have the trailing stop loss system, and of course, if you're using sector surfer, you probably have your own strategies already programmed in. So let's take a look at the 25% trailing loss system. This is a system that has few rules. First, if you really want to buy a stock, you don't want to risk more than 1% of your total portfolio on any one stock. Each stock carries idiosyncratic risk. In other words, stock-specific news can tank that particular stock overnight. So if you're going to protect your losses to only 1% of your portfolio, you can buy up to 4% of your portfolio's worth of that one stock and then put a 25% trailing stop loss order immediately. This way, the most you can lose, unless it gaps down, is 25% of your stock value, which makes up only 1% of your total portfolio value. If the stock goes up 33%, go ahead and buy another block of stock using another 4% of your account. Remember, if the stock goes up 33% and goes down 25%, you're broken even. Just like how when you lose 25%, you have to gain 33% just to break even. Just keep monitoring those stop losses and repeat until stopped out. Stop losses should be automatic, but remember, some of these brokerages may not keep stop losses in place for more than 60 or 90 days. So question your brokerage, keep an eye out. The next system is monitoring your own sector surfer system. Now, sector surfer is basically improvement over classical pie chart investing, if structured correctly. So sector surfer, you can think of as having two main tools. There's a storm guard armor, which works like my 20-month moving average system, trying to determine whether or not it's relatively safe or dangerous to be in the stock markets. And then there's a sector rotation component like the MRI. So when storm guard armor thinks it's relatively safe to be in the stock market, you can use the sector rotation to figure out which of your list of up to 12 stock funds is safest to buy at any one time. And when storm guard armor says it's relatively dangerous to be in the stock market, let the sector rotation figure out which bond fund or other alternative investment fund is relatively safe to be in as an alternative. Unlike my previous videos when I keep admonishing don't combine systems, Sector Server can combine both elements into one combined system. So here's a traditional pie chart we've been modeling as an example. I introduced this last month. This particular pie chart is a 70-30% stock bond pie chart where you have total stock market, real estate, international stock, emerging markets, and then for bonds you have long-term treasury bonds and TIPS. Theoretically, if you have any one of these particular funds crash on you, theoretically the rest of the fund should be robust enough to prevent big losses. And so this month, if you take a look at all the components of these funds, the yellow line is what happened. By definition, it does average, so it never does as badly or worse than the worst fund, but then it also never does as well or better than the best fund. That's what average does. Now, if we were to use the storm guard and sector rotation features of Sector Server, you can see that this 1 month, we stayed in the total stock market fund, which very closely paralleled the S&P 500 index fund. The white is the S&P 500. The red and the yellow is the total stock market fund. So yes, all three alternative stock funds, the emerging markets, the total international stock, their real estate, all beat the total stock market fund. But in general, remember, we're not trading more than 3 or 4 times per year. So sometimes other funds does better, but right now it's relatively safe to be in stocks in general. And a couple of months ago, Sector Server determined that the total stock market fund was the safest among the 4 at the time, and there has been no real data to indicate otherwise yet. So Sector Server is a strategy that if you set it properly, they will text or email you with alerts. But I emphasize, log on periodically, just to make sure you don't have any trade signals that you missed. And also, it's a good idea to keep logging on because if you're like me, I forget how to log on if I don't log on very often. And since Sector Server generates a signal, maybe only once to 5 times per year, it's unlikely that you would log on to Sector Server that much either. And it's nice to be in touch with what you're doing. So remember, this month, for Sector Server, it's safe for stocks and stayed in total stock market fund, or I put down S&P 500 by mistake, as a stock fund of choice that has continued this month. So in summary, remember, I just went over several different systems. Don't mix them up. Even the Sector Server. The Sector Server is a combination of 2 different systems, but at least they're built to be together. It's been back-tested. At least you should back-test your systems before implementing them live. I went over the 20-month moving average system, the MRI system, dealing with stock tips, and of course, monitoring your Sector Server strategies. So keep those questions coming. I know I talked to several of you personally each month, but for those of you who have only heard about me indirectly, maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague. Here are ways to get in touch with me. Drop me a line, give me an email, call me, set up an appointment. A few of you I've talked to, you know your stuff. You're fine. I don't have to worry about you. But for some others, holy cow, it's clear you need help getting your financial life in order. Don't be bashful reaching out for help. The more you delay, the more time is against you. So, until next month, invest safely.